It was supposed to be fast, clean, and final. A single trade placed by enormous capital timed precisely for maximum fear. For a few hours, the screen agreed. Prices fell, voices panicked, and headlines quietly prepared the obituary. And then, something unexpected happened. Nothing behaved the way it should have. The fall stopped. Buyers appeared where they were not supposed to exist, and the market refused to finish the story. This was not a rescue. It was not luck. It was something far more dangerous, because when a planned collapse fails, it means the system itself is changing, and most people will only realize it after it is too late. Welcome to the currency game. If you have been watching markets for decades, or if you simply want to understand what truly moves money, consider subscribing. Not because it is trendy, but because experience teaches one thing very clearly. It is better to understand risk early than to explain losses later. And before we begin, tell us where you are watching from, because currency stories are never local. They are always global. They had seen this pattern before. In commodity markets, especially metals, large downward moves rarely arrive without planning. When silver began to fall sharply, experienced observers did not ask whether it was intentional. They asked who was behind it, how much force was being applied, and what reaction was expected. The assumption was simple. A powerful trader, widely described as a billionaire, had built a massive short position. The logic behind such a move was familiar. In thin liquidity conditions, heavy selling can trigger stop losses. Those stops trigger more selling. Margin calls follow. Panic does the rest. For a short period, the plan appeared to work. Prices dropped quickly. Commentators spoke of collapse. Retail traders rushed to exit. The market narrative shifted from strength to fear in a matter of hours. On the surface, this looked like a textbook execution of market pressure. But beneath the surface, something unusual was happening. The selling did not accelerate. In past cycles, once silver broke key levels, selling usually fed on itself. Liquidity would vanish. Buyers would step back. The price would slide until forced liquidation finished the job. This time, the process stalled. As prices fell, buying quietly increased. This was not emotional buying. It was not driven by excitement or hope. It was structured, measured, and steady. That difference mattered. The shock had been delivered, but the system did not fracture. Instead of disorder, the market absorbed the pressure. Within hours, silver stabilized. Then it moved higher. Not slowly, not carefully, but with urgency. By the end of the session, prices were far from the lows. The crash narrative could not survive the reversal. This is where the story becomes important for serious decision makers. Markets communicate through outcomes, not intentions. And the outcome was clear. A concentrated short attack, even one backed by enormous capital, failed to control price behavior beyond the initial move. That failure carried information. In financial systems, power is not measured by how much force is applied, but by whether the system responds as expected. When it does not, assumptions must be questioned. The short position itself was not small. It was large enough to move prices, influence sentiment, and dominate headlines. But it was not large enough to maintain control once counterforces engaged. Those counterforces were not visible to the average observer. They did not announce themselves. They did not create noise. They operated through quiet accumulation, disciplined risk management, physical demand, and institutional strategies designed to exploit imbalance rather than chase fear. The failure was not about silver being strong. It was about the market being more resilient than anticipated. The question is not why silver bounced. The real question is why a carefully planned collapse failed to finish its job. And that question changes everything that comes next. What stopped the collapse was not emotion. It was structure. To understand why the shock failed, one must look beneath the price chart and into the machinery that now governs modern commodity markets. Silver did not resist pressure because it was popular. It resisted because the system surrounding it has changed quietly over the last decade. In earlier eras, markets were simpler. A large trader could apply force in one place and expect a chain reaction everywhere else. Futures exchanges dominated price discovery. Physical demand followed paper prices. Liquidity was centralized. Fear spread faster than information. That world no longer exists. Today, silver trades across fragmented systems. Futures contracts in New York, physical markets in London, and growing demand hubs in Asia all operate with different priorities. Pressure applied in one venue does not automatically transmit control to the others. This fragmentation weakens dominance. The Billionaire short bet relied heavily on paper instruments. Futures contracts allow large exposure with limited upfront capital. They are powerful tools, but they come with strict rules. Margin requirements, position limits, and real-time risk controls now act much faster than they did in the past. When prices moved sharply, those controls activated. As volatility increased, margin requirements adjusted. That forced both longs and shorts to reassess exposure. Importantly, it limited how aggressively additional pressure could be applied without increasing risk to the short seller. At the same time, buyers were not absent. They were selective. Institutional buyers do not chase price. They wait for dislocations, When forced selling appears, they step in not to support price emotionally, but to rebalance exposure logically. Their buying is quiet, patient, and resistant to panic. Physical demand also played a role. Unlike futures traders, physical buyers are less sensitive to short-term price moves. When prices fall sharply, physical demand often increases rather than disappears. This creates a natural counterweight that paper markets cannot easily overwhelm. Another critical factor was arbitrage. In modern markets, price differences between regions attract immediate attention. When futures prices fell faster than physical markets, arbitrage desks moved to capture the gap. This activity does not seek to predict direction. It seeks imbalance. In doing so, it stabilizes price behavior. The short strategy depended on speed. It needed the market to cascade before these mechanisms engaged fully. That window was shorter than expected. Automated systems now respond within minutes, not hours. Risk desks monitor exposures continuously. Clearinghouses enforce discipline aggressively. The result was containment. The selling achieved an initial drop, but could not create follow-through. Without sustained momentum, fear could not compound. Without compounding fear, forced liquidation stalled. This is where many observers misread the event. They focused on who placed the bet. They focused on how large it was. But size is no longer the decisive factor it once was. Structure is. Markets today are designed to survive shocks, not because they are safer, but because instability threatens the entire financial system. After years of crises, regulators, exchanges, and institutions have quietly reinforced the plumbing. This reinforcement does not eliminate risk, it redistributes it. Pressure no longer breaks markets where it is applied, it migrates. It looks for weaker points. When it does not find them, it dissipates. The short bet assumed that liquidity would vanish. Instead, liquidity shifted. It assumed that fear would dominate. Instead, discipline intervened. This does not mean the strategy was irrational. It means it was based on an outdated understanding of how control functions in modern markets. For decision makers, this carries a broader lesson. Power strategies built on overwhelming force are losing effectiveness. Systems respond faster. Counterparties are more diversified. Exposure is managed across regions and instruments rather than concentrated in one place. The silver market did not defy gravity. It revealed that gravity itself now operates differently. Understanding this shift is essential because the same mechanics are present in currencies, energy markets, and even equities. When pressure fails to achieve its objective, it signals not strength, but adaptation. And adaptation changes the balance of power. The next question is no longer about mechanics alone. It is about what this failure says regarding who truly controls capital flows today and who no longer does. That is where the story moves next. The most important signal was not in the price. It was in the loss of authority. For decades, financial markets operated on an unspoken assumption. Those with the largest balance sheets could shape outcomes. Influence followed scale. Reputation substituted for resistance. When capital moved with confidence, the market adjusted. This event challenged that assumption. The failed silver collapse did not expose a weak trade. It exposed a weakened form of control. The strategy depended on an older hierarchy, one where concentrated capital could still command obedience from fragmented participants. That hierarchy is eroding. Modern markets are no longer ruled by singular actors. They are governed by networks. Capital now flows through systems designed to neutralize unilateral dominance. This does not make markets fair. It makes them less controllable. The billionaire short was an expression of authority. It relied on credibility, size, and historical precedent. In the past, those elements were often enough. Other participants stepped aside. Liquidity thinned. The trade completed itself. This time, the market did not step aside. Institutions did not retreat simply because a large player appeared. They evaluated risk, pricing, and structure independently. Algorithms did not defer to reputation. Clearing systems did not relax standards. Physical demand did not pause out of respect. Control met indifference. This indifference is the new signal. Power in markets is shifting away from individuals and towards systems. Balance sheets still matter, but they must operate within tightly monitored frameworks. Influence now requires alignment with structure, not defiance of it. Another layer of the shift lies in information. Markets no longer process narratives sequentially. They process them simultaneously. By the time the story of a collapse reached the public, professional desks had already evaluated the mechanics, the limits, and the probability of follow-through. The reaction was not fear, it was calculation. This recalibration affects more than silver. It reflects a broader constraint on speculative power across asset classes. Energy markets, currency markets, and even government debt now exhibit similar behavior. Attempts to force outcomes increasingly result in volatility without resolution. That volatility creates opportunity, but it also reveals limits. There's also a political dimension to this shift. Regulators and exchanges have little tolerance for disorder that threatens confidence. After years of systemic stress, tolerance for unchecked leverage has narrowed. This does not eliminate aggressive trades, it caps their reach. The Billionaire short ran into these invisible boundaries, not imposed by a single authority, but by overlapping systems designed to prevent exactly this type of destabilization. The result is a market that bends under pressure but resists collapse. This resistance is not permanent, it is conditional. If confidence erodes broadly, if liquidity withdraws across multiple fronts, control can still be lost. But isolated attempts, even large ones, now struggle to trigger systemic outcomes on their own. For business leaders and investors, this matters deeply. Strategies based on dominance must adapt. The environment now favors resilience over aggression, timing over size, structure over bravado. The event sends a clear warning. Legacy playbooks are aging. The tactics that once worked through intimidation and momentum now face diminishing returns. Markets are not becoming weaker. They are becoming harder to command. This does not mean capital has lost power. It means power has become distributed. And distributed systems behave differently under stress. Those who fail to recognize this shift risk repeating strategies that no longer deliver results. Those who understand it can position themselves to survive and possibly benefit from the next phase of instability. Because while control has weakened, uncertainty has not. And uncertainty always creates consequences. The final question then is not who caused the move, but what decision makers should watch next as these limits are tested again in other arenas. That is where the story must turn. The failure of the collapse was not an ending. It was a signal. In financial systems, the most dangerous moments are not the ones that break markets. They are the ones that reveal stress without releasing it. When pressure is applied and does not resolve through collapse, it remains inside the system. That tension does not disappear, it migrates. For decision makers, the priority is not predicting silver's next price. It is understanding what conditions allowed a large shock to fail and how those conditions could change. The first signal to monitor is liquidity behavior. When markets absorb pressure smoothly, liquidity appears stable. But stability can be deceptive. Liquidity today is often conditional. It exists until volatility exceeds tolerance thresholds. When those thresholds are crossed, liquidity can vanish quickly. Executives and investors should watch how spreads behave during stress. If spreads widen abruptly after previously absorbing shocks, it suggests fatigue in the system. The second signal is positioning concentration. Failed breakdowns often encourage repetition. Traders may assume that another attempt, larger or faster, will succeed. This can lead to dangerous clustering of similar strategies. When too many participants lean in the same direction, the system becomes brittle. Position reports, options activity, and funding rates often reveal this crowding before price does. The third signal is policy and rule response. Markets today operate within narrow tolerance bands set by exchanges and regulators. If volatility increases, rules change. Margin requirements rise. Position limits tighten. These responses alter incentives immediately. Decision makers must understand that regulation is not static. It adapts in real time. A strategy that works under one rule set may fail under the next. The fourth signal is cross-market behavior. This event did not occur in isolation. Movements in currencies, energy, and risk assets provide context. When stress appears simultaneously across multiple markets, containment becomes harder. If silver volatility begins to align with currency instability or funding stress, the risk profile changes dramatically. The fifth signal is narrative acceleration. Markets break not when prices move, but when confidence shifts. Watch how quickly explanations change. When narratives become inconsistent, when official explanations lag price action, uncertainty increases. Uncertainty is the fuel of disorder. For entrepreneurs and business leaders, the lesson is not about trading metals. It is about leverage discipline. Systems that rely on force rather than flexibility are vulnerable. When conditions change, they fail abruptly. This applies to balance sheets, supply chains, and expansion strategies. The same mechanics operate everywhere capital is stressed. The silver event shows that resilience now matters more than dominance. Survival matters more than speed. Understanding structure matters more than confidence. The warning is subtle but clear. When markets stop obeying old commands, they are preparing to teach new lessons. Those lessons are rarely gentle. The next phase will not announce itself loudly. It will emerge through smaller signals, repeated tests, and growing instability at the edges. Decision makers who watch carefully will see it forming. Those who do not will only recognize it after the consequences arrive. And by then, the cost of misunderstanding will be far higher than the cost of preparation.